welcome to the first episode of Beyond the Balance Sheet. I'm sat with Dan Thompson, International Wealth Manager and Advisor to high net worth individuals and family offices. It's going to be a very valuable podcast. What can we expect to learn for the audience, Dan?
Yeah, well, thanks for having me. First of all, I do appreciate it.
Pleasure.
Well, like you said, I work with a lot of high net worth individuals, essentially manage their money, work in wealth management. So probably a lot of the value I can add today is helping people kind of understand different ways they can grow, protect their money, the habits of, I suppose, highly successful people. And I suppose some general business strategy. I get heavily involved in a lot of people's careers, businesses and whatnot. So after doing this for nearly 15 years now, there's not many things I've not come across, I suppose.
And you're, similar to me in some way, where you don't necessarily fit the typical stereotype of a wealth manager. Quite a lot of IFAs, they're a little bit different than your profile on social media. You've gone down the personal branding route. How would you say that's differentiated you from others that could advise clients?
Yeah, I think that's a really good question, actually. I think your typical financial advisor, wealth manager, they get used interchangeably, I suppose. Tends to advise kind of general public, and it tends to be quite limited, the range of kind of services they offer. So investments, pensions, insurance, that sort of thing. I think the difference, and obviously this is very similar to yourself, right? The difference with what I do is it's a lot more holistic. So not just with the stuff I can actually implement myself. So we do everything from private banking, lending, estate planning. We've got legal. We've got some great tax people we know, for example. But then outside of kind of almost like the central proposition or investment firm, there's a lot to do within my network, connecting clients, other professional connections, and I suppose the goal really is to be that go-to trusted advisor to solve 99% of my clients' problems, and they're not always financial. If a client goes through a divorce, they call me. Client's got a problem with their business, still a member of their staff, they call me. It's not necessarily about their money.
Yeah.
So I think that kind of really sets you apart. And then there's some investments that I get involved in that are quite unique to more high net worth individuals, which typically aren't accessible through what I class as the retail market. So
a lot of client relationship as well is relatability, and IFAs, wealth managers, sometimes it's purely financial conversation with their client, whereas they can learn off you in multiple different ways, because you're also a great entrepreneur, you've also got a great personal brand, you also understand the entrepreneur and the client that you're dealing with. Yeah. So it's a different type of relationship that I suppose you can have. And how do you feel that's helped you build a client base and grow? And you mentioned network then. How important do you think that is to building a business?
I think it's so important. Again, that's probably one of the biggest USPs I have. I've built multiple businesses, sold a couple along the way. With the investment firm in particular, a lot of the advice I give to my clients, especially ones who are a similar age to me, is exactly what I'm doing for myself. So I speak firsthand. I'll be really transparent about the things I'm doing, whether it's the sort of investments are going into, the way I structure my companies, what I'm doing, obviously on the tax front or whatnot. So I think it means you're a lot more relatable, and you have the same obstacles, you share the same sort of successes. So like you said, it's a lot more relatable. Now, if you're an advisor, or like you're, Josh, you're a typical accountant or tax advisor, you tend to be working for a corporate company. You've not had that sort of exposure. You've not gone through the sort of pains or struggles that some business owners or some of your clients have. So they view you as, I suppose, on the same level as their peers. Right?
Yeah.
So that probably is a massive differentiator in why I've got the sort of clients I've got, and the network, I suppose.
Yeah, because there's theory and there's practical. So theory is your qualification, it's going through college, it's doing your exam papers. But even with accountancy, similar to us, if you don't have the practical experience, then you don't actually know how to implement all of that theory into real world examples and help clients manage money, save tax, whatever it may be. So you've got to have both, which is why personally I did my qualifications alongside always working. So I always had that insight into clients and the practical situations of how to help. So you've got qualifications, you're chartered, is that right?
Yeah.
Okay, and how did you find going through the qualification process to get to where you are now?
I think it's an interesting one, right? Because I did a master's in what I did, and I'm not particularly academic. I say this to clients all the time. I just grafted to get through that. And then after I came out of university, then you go and through the industry qualification. So then I did all the kind of investment exams, went on to do the chartered exams, which puts you kind of at the pinnacle of the profession in terms of technical knowledge.
Yeah.
But some of that's great, and you can implement obviously a lot of it, but then what's missing there is real world, real life experience. And again, I'm sure you have the same sort of conversations. I'll have to tell them the kind of theory and then the reality of what happens sometimes in life based on my own experiences or other clients' experiences. That's the great thing about my job. For 15 years, I've been helping highly successful people build wealth, protect their wealth, achieve their financial goals, family goals, whatever it may be. You learn from your clients' experience really quick at early age. That's probably the best part of my job, from early 20s to obviously, sadly, mid-30s now. You get all this experience, this life experience that most people wouldn't have. And then you can share that with other clients, right?
Of course. And we're both huge on self-development. I mean, we've met before this podcast, right? Yeah. I'm a client of yours, you're a client of mine. So we've already got some commonality and some synergy. But we have a cheat sheet to self-development because we speak to so many high-achieving entrepreneurs that are the best in their fields. For yourself, high net worth. High net worth is going to be a byproduct of someone doing well in their field. So you speak to the best of the best in all these different industries, and I'm the same. So we accumulate knowledge so much quicker. Which it really is a cheat sheet for us, and why we as advisors can actually provide a better service to the clients we're speaking to, because we've also understood the cheat sheets in e-commerce. We also understand the mindset shifts that you need as a successful entrepreneur. So them gems are really important for us. Now, getting back to the actual wealth management side of what you do for your clients, who's your typical client? What do they look like?
Yeah, before I answer that, one thing that's really important, and I think you kind of alluded to there, is because you've got different clients, right, in different industries, you can connect dots which most people can't. Because if you work as a business owner in, say, one specific industry and you don't have exposure, like we both deal with guys in e-com, and we might be dealing with a CFO of a major FTSE 100 company, right? So they're at different ends of the spectrum, probably in age, even maybe in level of wealth, a sort of way of adopting tech and AI. So you can see all these different moving parts, connect dots that most people can't do. And I think that's a massive advantage.
It also helps us with our businesses as well. Because like when I'm speaking to a client, I'm also looking to learn. Like we're the service provider, but I'm looking to learn from that client as well. And a lot of the benefits and the success that I've had in my businesses has been from learning from clients and being around that higher level of entrepreneur where their mindset is so much better and so much further than your general Joe that you would meet in the public. That progresses you massively. So it's really helpful, and for us, it's a real cheat sheet for us to build our own businesses as well.
It's the best part of doing the job, I think.
Of course it is. Well, the people is everything in the job. Like it's not just the numbers. P&Ls and balance sheets and stock charts are all great and part of the job, but it's the relationship that you can build with the client. It's the connection that you can have. That's what really sets us apart. And also when we can then put that online, which is that personal branding side. You mentioned AI then. AI is leveling the playing field across the board because the cost of intelligence is going down because AI is doing a lot of it for you. So who are going to be the advisors that these clients go to? It's going to be the ones with personal brand and the ones that they can feel connection to, which is why I think you've done exceptional getting the personal brand that you've done.
Yeah, well, thank you.
It's okay.
Anyway, sorry, your question, Dosh.
So going back to the type of client that you work with, what's the client profile? Who did a lot? I'm sure there's different variations, but give me a picture of your clients.
So back in the UK, my general client demographic, rightfully or wrongfully, is mainly 40 to 65-year-old men. Business owners, directors, C-suite, high-level execs, and quite a few corporates. We do a lot of work for companies. In Dubai, it's like the other end of the spectrum. So I would say from age, well, probably less than 20. We've got some clients who are younger than 20, but 20 to probably 40. The average client age here is probably about 26.
Big difference.
Big difference, because the average age must be probably 50 to 55 in the UK, right? They are mainly online entrepreneurs, influencers, sports professionals, completely different kind of market, and it's even easier for me to relate to them, because most of them are a similar age or not too far away from my own age. The level of wealth is also disproportionate. I a few years ago thought I had the best client bank in the world in the UK. I've got all these top business owners, directors, and I thought, you don't get much better than this. They're obviously on significant salaries, or their businesses are doing exceptionally well, multi-millionaires. And then you come here, and you meet 21-year-old guys that are doing 5 million quid a month, USD. And you're like, right, okay, this is probably more money than my top client makes in a year in the UK. And obviously then they get taxed, right, and lose half of it.
Yeah.
So it's a completely different type of clientele out here in the UAE.
So you are a wealth manager.
Yeah.
So in order to speak to yourself and actually engage in services and get into investing, do you already have to be wealthy?
No, so I think that's a common misconception. I think what you need to do is find the right sort of service that is tailored to you. So if someone came to me and they were starting out, for example, we would still speak to them in the business. We've got a number of advisors that could kind of point them at least in the right direction.
Okay.
They might not be suitable to come on board as a client because we offer a range of services and it won't be cost effective for them. So you've got to be honest, right? Do the right thing by people and say, look, we could do this for you, but you're not going to take advantage of private banking. You don't need any estate planning. At the minute, all you want to do is put £100 aside a month into an investment account, right? So the best thing to do is point them in the direction of what we call a kind of high street IFA, independent financial advisor, like a local firm, or maybe even give them some options in terms of how they might start investing through like a platform. But again, you have to be very careful in the industry, right? You can't technically advise on other people's products, solutions, other firms. So you just give them a range of options. But I think everyone should take advice. Without a doubt, the sad reality, especially of things in the UK, is there is a huge advice gap. It isn't accessible. And that's why, obviously, you're great at this, but I certainly need to be better. I've tried to put more free educational content out there. Obviously, I was doing it yesterday because the people who probably need financial advice, good financial advice the most, are the people who are on lower incomes and need to make the most of their money, right? And it's just not available to them. And now with Consumer Duty coming in the UK and making things a lot harder for investment firms in terms of all the due diligence, the background stuff we have to do, it's now even less profitable for us to look after clients.
So speaking to them, two demographics, so the individual that you just mentioned that may not be quite right for a wealth manager or your own firm as of now, if they went to speak to a more high street IFA, what would they then be looking at investing in? Would it be just general stock market? Would it be equities? Would it be pensions? What would you advise?
It's a tough question because and this applies to someone who's just starting out and someone who's got 10 million to invest, right? It is all dependent on their circumstances, goals, risk tolerance, capacity to take risks. The list goes on. We've got to spend hours with the client to assess that. And even if someone was starting out and going to kind of a high street advisor, they would need to go through the same process. So that is where an advisor adds a lot of value. There's some really great research out there. Vanguard, funny enough, who are a passive investment company, they did a really, really good research paper called Advisor Alpha, and it basically illustrates in the paper that you can get about 3% per annum more on your money by having an advisor. It doesn't specify which advisor, whether it's a good or bad. Obviously, it helps if it's a good advisor who knows what they're doing. I think realistically, seeking advice and doing something, even with a high street advisor, is probably the best approach. What they put you into, to answer your question, again, it's going to be really hard because some investment firms will go into a load of trackers, and then I think they're not actively managing the money, and there's pros and cons to that. Might be suitable for someone with less money.
Just for the audience, what is a tracker?
So a tracker is basically, apologies. So a tracker is essentially a fund, so a collection of investments that tracks an index, a stock market index. So in the UK, there's the FTSE 100, which is the top 100 companies in the UK. In America, one of the most popular indexes is the S&P 500, which is the top 500 companies in the US.
Apple and Microsoft, right?
Yeah, Apple, Microsoft.
Tech companies.
Sadly, they make up of like 35% of the entire index. And I did a post about this, obviously, yesterday. So I think the key thing really is different investment firms have different investment approaches and philosophies. So you might, regardless of your circumstances being the same, your goals being the same, your risk appetite being the same, you could go to one firm and end up with a different portfolio of investments than another firm. And sadly, that is, again, issue that needs to be addressed in the industry, because there is a lack of knowledge or clarity around what is probably a better option for a client, and they're never going to be able to tell. If one advisor or high street advisors align themselves with Aviva, they claim independence, but all they've done is really decide they want to work with Aviva. They're funneling all their clients into Aviva funds, right? Whereas another independent advisor might genuinely be more independent, and he might assess the market. I don't know how he would technically assess 30,000 funds. So this is the kind
Could
of
be a busy boy.
Yeah, this is the ongoing kind of debate about what is truly independent or not. And that client would have a completely different outcome in terms of what they're invested in. Whether it's stocks, bonds, property, in terms of what they have in their portfolio of investments, so their collection of investments will be completely dictated mainly by their risk profile.
Interesting. So still speaking to that individual that may not enroll in your services of now, private banking, wealth management, how much would you say you need to start investing? Is there a minimum buy-in? What would you need to start?
Do you mean for general market or with us?
So the individual that would go to general market.
So I think really anyone who wants to put money aside can invest with a very little amount. I think a lot of online platforms will set up direct debits for like 20 quid a month. So people should be setting up and investing into things like pensions in the UK. It's one of the best, most tax efficient ways to invest. And I'm sure you tell this all to your clients. I think sadly the younger generation don't realise how significant there is, because I've never sat down with someone ever in the UK who's in their 50s and they've said, Dan, I wish I'd, not put as much money into my pension. They always say the same thing. I wish I'd started early. I wish someone had told me this. So I try and really hit that home with younger clients, start putting a proportion of your wage into pensions. Or if you don't want to wrap it up in a pension because there's restrictions and you can't access pensions till 57 in the UK at the earliest point, at least go into an investment account. So if you did need access to it, you've got liquidity, you can draw on it. But obviously the point is not to really do that.
And that's the power of compounding, right? If you invest from an early age, especially if you look at the Dubai profile of client that you're speaking to, some earlier than 20, if you start investing, especially at a fast rate at that age, by the time you get to 30, 40, you have a serious amount of net worth. And if you can also get tax benefits doing that along the way, UK limited companies, as of right now, 60,000 you can invest into a pension via a limited company and get tax relief on that. If you're at 25% corporation tax rate, that's 15,000 tax relief per year. And then that is going to compound then, providing your investments are in the right place.
Yeah, and that's, for you, obviously, in your role as one of the best types of advice I think you can give. And surprisingly, I've worked with so many of my clients' accountants, and I've mentioned that when they first come to me, and I've never met the client before, they come to me for advice, and they're like, why is my accountant never told me this? And it's that awkward conversation where I have to kind of say, I don't want to shoot the accountant, right? And being professional, I'm like, well, in all honesty, they probably really should have. Said something to you, and they've missed out on doing that for a long, long time. And obviously it is literally the most tax efficient way you can invest in the UK, right?
Yeah.
I would say near enough 95% of all business owner clients I have, if they can afford to, they max out their 60k annual allowance every year.
Yeah. And is that into, how would you invest that? If a client's coming to you and putting that 60,000 with you, how would you then invest that?
Yeah, so if they've already got a portfolio with us, it will go into their current investment strategy. We've agreed a mandate, we've decided what their portfolio should look like in terms of structure, the level of risk they're taking, the sort of growth expectations, their feelings towards the amount of volatility they'd accept. So in plain English, the amount the money goes up and down, of course, like per day or per month or whatnot. So it's really hard to say, because I've got clients who are really kind of bullish, they just want to grow the money. They are more sophisticated investors, they've got experience, so they pay no attention to the ups and downs. They just want capital growth, so the money grows a lot quicker, but it's a little bit more volatile. I've got clients who sadly check their app. They can see all the investments on their app
Every 5 minutes.
Every 5 minutes, and they know they should, and we have a laugh about it, in meetings. But if they are worriers, I don't want them to go to bed worrying at night. So even if they wanted to go high risk, I can't do it. I have to put together a portfolio of investments that are going to be a bit more of a kind of smoother ride for them. So they won't get as much growth, but they're not going to be kind of worrying too much, especially if there's a stock market crash of some kind.
Interesting. And just so they can understand that practically, that stays within the limited company. That's within the limited company wrapper. Is there a certain way that you would structure that?
Yeah, so it depends. It depends how they're investing. So if they have cash built up within their business as a business owner, they might be already taking the maximum amount of income they want to take relative to how much tax they want to pay. So I'm sure the sort of advice you give, Josh, you might want to limit a client's income to 50k roughly, so they're not going to a higher rate, or 100k, so they don't start losing personal allowances, or obviously even higher going into the additional rate band, right? So if someone's already kind of going up to the higher or additional rate, they may choose to invest the excess cash they're building up in their business into a company investment account. So it never leaves the company. The great thing is inflation's not eroding the cash. It's not sitting there. They're getting growth on it, so they're not losing the opportunity cost of capital.
Yeah.
They're growing it at 5, 6, 7, 8, 9, 10% net of fees, depending on investment strategy. And that's a really, really good option for business owners, because they might not have anywhere to allocate the cash. They don't want to pay it out and pay themselves income because they get hammered with income tax. There's no options right now maybe to reinvest in their business. So they've done as much as they can into, or want to, into marketing or systems processes or more staff. So the money's always trapped there. And I come across that a lot. I've come across businesses with an eye-watering amount, 7-figure sums, sometimes 8-figure, sitting in cash, and they simply just don't know what to do. And again, their accountant hasn't put their hand up and said, you know what, there's really good cash management facilities for your cash. Me and you both know a really good option for that. And there's also the option to go one step further and invest it and actually get some serious growth on it by setting up an investment account within the company. If they put the money into the pension, which is a good way of extracting it, as you know, that's then leaving the company. It's going from the company straight into their personal pension. And obviously that's a really tax efficient way to obviously reduce their income tax, go into a vehicle which is free of capital gains tax, and chop down their corporation tax liability, right?
Yeah. And just to touch on the 7 and 8 figure sums, I've seen that firsthand, and I've also seen 1% interest accounts with a NatWest baby account for a smaller entrepreneur. So even if you're not willing to go into investments and put it into equity plays in the stock market, you at least need to be in a higher interest, a cash management facility like you mentioned.
Even that, right? So you could have an investment account that is predominantly invested in defensive assets like bonds, right? So you could go into your cash management facility, so cash accounts for X amount. Say you had a client with £1 million sitting in cash, and they might need 200-300 more liquid, working capital, that sort of thing. Say there's 700 sitting there, and it's going to be sitting there for a good amount of time. Say they were really risk adverse and they didn't want to go into more kind of equities or stocks and shares in plain English. You can have a diversified portfolio of shares, bonds, other defensive assets, but if they really wanted to be cautious and just stay ahead of inflation, you could go into some high yielding bonds that are a lot more secure. You could even put some commercial property in there. I'm not saying we would do that. We're definitely not recommending that right now. And that is a really good option to eke out that little bit more of a return, 4, 5, 6%, as opposed to getting nothing on cash traditionally. I know rates are a bit higher at the minute. And that's a great option for them. Your example, by the way, we have an illustrative case study example of like a hypothetical £1 million, and the cash management facility, that we're talking about, the difference in interest rates, and this is on cash, this isn't even on the investment account. I think it was in the region of like 20, 30k, just for having their money into a proper cash management facility, a platform where they can move it between obviously different cash accounts. Huge. And the one thing that is not the point that's missed in that is it isn't even about the additional return. It's the fact that they're spreading the money across a load of different bank accounts at the click of a button and staying below the Financial Services Compensation Scheme limits. Because if you've got £1 million sitting in cash in your business in one institution, that is a massive risk, right? So the key to the cash management facility, especially when I'm dealing with FDs, CFOs, when I tell them about this and no one's told them, they can't believe it. Click of a button, £1 million can be spread out, and they only have to open one account. They don't have to go to loads of different banks and mess around.
So coming back to the 2 profiles we mentioned before, we've covered profile 1 that wouldn't necessarily come to you. They would go to more of a general market IFA, and they would start small, focus on compounding over time, and as they grow their wealth, potentially then come to you in the future. So focusing on profile 2, that this person is entrepreneur, they've already got a successful business, they've got surplus profits every month. When I'm speaking to that business owner, I want to make sure they're allocating their surplus capital in the right places for the best returns. Firstly, you're always going to put money back into your business, digital assets, physical assets, making sure you're getting the best return in what you know, which is always going to be your business first, right? Then you've got cryptocurrency, you've got the stock market, you've got other assets, you've got property. So how would you speak to a client that doesn't want to put all their eggs in one basket if they're asking you about cryptocurrency or other asset classes? How do you go through that conversation?
Yeah, that's a really good question, a very hard one to answer for so many reasons, especially on a podcast without getting deregulated.
Yeah, I imagine.
So I'll answer it as carefully as I can. With the sort of clientele here, you get those questions more, right? Especially with kind of like young entrepreneurs. I think what you said, the key starting point is recognizing if they should be putting more money in their business first. It's all about capital allocation. It actually is a skill to build up. And obviously someone like me or you, Josh, we're geared to help them with that. You know, we do it all the time. So we've built up a very strong skill set in knowing how to allocate capital, right? But for online entrepreneur that have no idea, so you've got to help them assess, you know, how much should they put money back in their business. They might get the best ROI, return on investment, sorry. But at the same point, they're exposing themselves potentially to risk. Because some of these online entrepreneurs, there's ones that were doing a stupid amount of money one year, and there's literally a client I can think of who now it's done. You know, he's with the wave is done. If he hadn't have banked money along the way, he'd be stuffed right now. So you've got to assess kind of how much money you want to reinvest within your business to get the maximum return on investment. If your business will give you the maximum return on investment, that is, because some of them won't. Then look at alternative ways to diversify through different asset classes, whether that be buying property, going into crypto, building a diversified investment portfolio with someone like myself or a wealth management firm. I think narrowing down who puts what where is so dependent on someone's circumstances. So there's a guy I met last week, me and you both know him actually because I introduced him to you, massive into property, back in the UK, you know, he's building up his property portfolio and that's all he's got. You know, so I'm like, right, you need to de-risk, you need to start putting money into an investment portfolio as well as building the business, the property and whatnot. If I meet a client, which I do, who's got $1 million in crypto, I'm like, right, you definitely need to de-risk and have more money in investments. And likewise, it can be the other way around. So if I've got a client who's heavy into equities and the sort of thing I suppose I spend most time on, I'll openly say to them, even though we won't invest for them, I'll be honest and I'll say, look, in your position now, maybe consider these other asset classes. The only one I can't really recommend is crypto. Because at the minute, with the lack of kind of regulation around it, the uncertainty, the volatility, it's not really recognised in the wealth management industry as a legitimate asset class. Now, we have trackers and stuff coming in. I'm sure it will at some point. I have no dispute about the technology, the blockchain, like what it's all about. I think as a wealth management strategy, if I'm, for example, managing your money, Josh, literally, if I said to you, right, we'll put X amount of your money into crypto, I know there's a probability that money might not be around in 5 years or 10 years. Yeah, high chance it probably will with the way things are going, but it might not. So I just can't take that risk for you as a client. Off record, if you said to me, Dan, I've got this much in crypto and it represented 0.1% of your overall wealth, do you think it's a big problem? I'd probably say no. You know what, I've got a small position myself, as an active interest, but I would I have more than 10%, 5% of my net worth in it? Absolutely not. That will be obviously controversial because some people are so bullish on it. Of course. But as a risk management play, because that for me is always priority, risk management number one, then returns. I wouldn't build my wealth necessarily through crypto as a primary source of.
So you would say, recapping that, focus on your business first, if you can, if you can get the best return.
Absolutely.
I mean, it always comes down to whatever you're focusing on, what's the best return on your capital? What's the best ROI? So focus on your business first, then make sure you're diversified by going into asset classes like equities, stock market, potentially property, potentially bonds. And you would sit down with that client and understand bespokely what's best for them based on their risk profile. If they do want to go into cryptocurrency and they're happy with that risk, then that's not something that you would
necessarily recommend, but I'd give them guidance on it. These are what I try and explain to clients. It's a bit like playing a video game and clicking save, right? So some clients never click save. They're just reinvesting in their business blindly or into stuff like crypto. And if crypto doesn't work out, tanks, something happens, the government pulls something in where like people can't use it or whatever, they're stuffed. If their business next year is no longer in existence, they can't sell it, they're stuffed, right? So what you've got to try and do is get as far along in the game as you can, but click save along the way. And by that, what I mean by that is bank money into something that is a lot more secure. So for some people that's property. I'm not particularly very bullish on property. I think that it's more traditional, old school way to invest. I think there's better ways to invest where you have less risk, better return, and in the UK definitely pay a lot less tax and a lot less cost.
Yeah.
So for example, if we create an investment portfolio for a client, as you well know, Josh, it holds 2,000 positions all over the world in different industries, sectors, and so forth. To lose your money is virtually kind of impossible. I can never say it's not. Compliance will kill me, especially with this going out into the world. But you need essentially 2,000 companies to disappear overnight, which has never happened in history. The worst scenario we've had is a Great Depression, or more recently a financial crisis, right? So if clients are not, or individuals, even people who are obviously, they need to own a business, people in their careers, aren't banking money into these kind of what I class as safety nets, and they're plowing all their money into more exotic investments, or if they are business owners, their own business, it's kind of at their own peril.
Yeah. So touching on the stock market, which is obviously what what you said you focus the majority of your time on.
Yeah.
We've had two pretty major events in the last 5 years.
Yeah.
COVID, Russia, Ukraine.
Yeah.
What's your outlook on the upcoming 5 years?
Yeah. Really good question. So do you want the real honest one?
And
it takes
honest and raw.
This is honest and raw, right? No one knows, and any advisor, wealth manager, economist, hedge fund manager that puts stuff out there is way too many variables to predict what's going to go on with the world. And I've seen it time and time again. So I sat on a webinar once with the former governor, Mark Carney, and he put all these predictions out there. I was wrong. I've sat on into seminars, gone to meetings with top fund managers, economists, repeatedly wrong. We've got research from some major investment houses who I won't name names. Probably shouldn't have said that other name earlier, to be fair. And their data that they provide us as investment firms doesn't tend to always be right. I mean, sometimes they get there or thereabouts, but it's because so much changes, and the markets are driven by investor psychology, not necessarily the fundamentals, the intrinsic value of a company. It's really driven by psychology. So a lot of major investment firms prefer to hire psychology grads now as opposed to investment management grads, which is quite interesting.
Yeah.
So to give you an honest answer, no one really knows. But to give you some answer of value, what I would say is when you're looking ahead and thinking, right, how do I invest? How do I allocate money into, say, the stock market? You want to be looking at like a 5-year play. You don't want to be worrying about the white noise, what's happening today, what Trump's up to, for example, right now. You want to be thinking, right, 5 years from now, is the US, for example, going to be one of the most dominant economies? Well, high probability. Are most of the top companies in the world based in the US? Yeah, they are. So there's no coincidence that a lot of wealth management firms, including us, have a high allocation to the US.
Yeah.
Now, whether the US tanks this year because it's overvalued at the minute, price to earnings ratios are like through the roof, valuations are high. It doesn't actually matter. And clients look to me all the time and they're like, damn, but what happens if the US drops back? And I mean, we had obviously a conversation like this recently. Well, realistically, if it does, it will recover like it always has over the coming years. Over a 5-year play, will it do better than probably other regions? Most likely, So I don't know if I've answered your question there a bit.
No,
you're tried my best.
Yeah, I think a lot of investing's a tough topic to give specific because, like you said before, it's got to be bespoke to the individual. What's your risk profile? What's your time period that you're looking at investing over? And how much do you actually have to invest? The answers are always going to be a little bit different. You said something interesting before I just want to touch on. You said market is based on the psychology of the companies. And I assume that you're meaning I know we had a discussion the other day off camera where you said analysts will look at the company and predict what their earnings report is going to say.
Yeah.
So can you just give a little bit on what an earnings report is?
Yeah.
And also just touch more on the psychology of that?
Yeah. So behavioral finance specifically is a really it's field in its own right, and analysts are a key driver of how share prices play out essentially. So if there's an earnings report, so companies are going to declare what level of earnings they're going to do, or any sort, it doesn't have to necessarily be an earnings report, it can be any bit of news that's coming out of a company. An analyst will interpret, or multiple analysts in different investment firms, and you get the research from all the investment houses as a wealth management firm, and they'll interpret what they think is going to happen. And again, that's someone's opinion, right, based on the data they've got. And they may think it's good, bad, or whatever, but regardless of their opinion on it, when the actual event occurs, so say the earnings get declared and how well a company's done, even if the analysts thought the company was going to do really well and achieve X, if the report comes out and it's a lot better, the stock price will go up, even though the analyst was kind of right. It'll go up higher than what the analyst's expectations was. But what's more interesting is if the analyst thought it was going to be really good, it is really good, but not as good as what the analyst was predicting, the share price goes down as a result. So the stock market is purely based on people's opinions or their thoughts on the value or what a company is worth. It's not necessarily based on the fundamental value of a company. So like when you would assess a company, Josh, great example, right? You'd go into kind of the financials, you'd work out kind of what multiple the company may sell for based on maybe comparables in the industry, and you'd come to a conclusion, right, this company is worth X. But as me and you both know, a business owner who's selling the company will probably think it's worth more. The seller, the buyer side, will think it's probably worth less. And you've got to kind of be the guy in between who's like, right, we're going to pull this together. And that's exactly what happens with the stock market.
Yeah, interesting. It's not an easy thing to navigate.
No, and that's why there's the opportunity for arbitrage, right? So in short, when the stock market gets hammered, what happens is the intrinsic value of companies here, so the true value in plain English of the company is here, or what it should be, and the share price is here. And there's an opportunity to get in a low point. But the problem you've got, because of herd mentality, is everyone's too scared to invest. There's a pandemic, like everybody doesn't know what's going on. I mean, the government doesn't even know what's going on as well. So you try and convince investors to say, look, now's the right time to invest. And it's only really clients of mine that have been with me for some time that tend to have the experience and the foresight to know, right, this is the right time to go in, especially if I'm doing it myself. And kind of
So question on that then. When is the right time to invest? So we've had two major crises, essentially. Yeah, Russia, Ukraine, we had COVID. We've now got emerging markets like AI. We had the DeepSeek, which has tanked the Nvidia stock price. I think it was 17%, over $1 trillion wiped from the stock market. So can you time the market? Is there a specific time that you should wait for to invest, or what's the answer to that?
So short answer is no. There's a famous saying, I'm sure you've heard many a times, a lot of people probably have. It's not about timing the market, it's time in the market that matters. So the minute you have the opportunity to invest, not in all cases, this is a very blanket statement, you should just get your money in, and let it compound and do its work, or whoever's managing your money, let them do their job, and try and just focus on whatever you're doing, building your business, your career and whatnot. The only time I think there's an exception to the rule, and I have to be really careful what I say here on the podcast, is I'm not saying you should necessarily time the market here, but if the market drops back and you can see it's dropped back by 25, 30, 35, 40%, like we've seen in major market events like the financial crisis, the pandemic, the market's dropped back considerably, it is clearly a discount. It's just like if the house price went back 10, 20, 30%. And there is grounds to really consider putting more money in a portfolio or into the stock market at that point in time, right? The concerning thing for investors will be that they may think the market is going to drop back more, and it most likely will. You'll never catch the bottom, like you'll never sell out at the top, but you don't need to. If the market's down 20% and you went in and it drops down to another 25, 30%, that might then bottom out and then it will start to recover, like markets have always done and have always recovered. So I think the point really is, no, don't time the market, just get your money in if you've got the opportunity to. But if an opportunity comes along where the world is terrified, that's actually a good thing. I train my clients to think when the world is scary and is volatile and the news is kind of really pessimistic, remember behind the scenes, volatility is our friend. For me, I'm going to find it easier now to make you money. So they don't need to invest more with me necessarily, but I try and remind them to think, right, I'm going to be having a field day at my side. We're going to be getting opportunities at a lower price. It's a great thing. So now when my clients' portfolios drop back, instead of like most clients and thinking, they're on the phone to me, Dan, like, is everything all right? What are you doing? I don't get calls, and everyone's, hopefully, or most of my clients are thinking, right, this is brilliant. Dan's going to be doing his job. The investment team are going to be taking advantage of it. Brilliant. We've been waiting for an event like this for 5 years. So it's changing their mentality. And it's all about the educational piece with clients, right?
I'd imagine not all wealth managers think that way. If there's a big crisis, if I had money invested with you, you're going to look to the person that you associate that money with, which is yourself. So I imagine you had some tough conversations with clients when the markets did tank through COVID or through Russia and Ukraine or whatever the market looks like. So when you're having them conversations, is that then trying to make them understand that this is opportunity, not necessarily a major event that you're not going to recover from?
Funny enough, it's almost like the reverse. I don't really have to have those questions, because what you do is when you take a client on board, you set the expectations from the start and you be honest. And some advisors are probably scared to be that direct and honest. And you've got to tell them there will be a time where your portfolio drops back. It is part and parcel of investing.
Yeah.
And when that happens, this is what we'll be doing. This is why you won't need to panic. We've got one of the best investment teams in the UK. This is what we'll most likely be doing about it. We'll be on the phone to you, speaking to you, and you get rid of the problem before it becomes a problem. So when the pandemic happened, I had advisors calling me across the UK who were less experienced or just wanted some general guidance. And like, damn, we can't see our clients because it's obviously a very in-person kind of thing, or it was before the pandemic. What do we do? So we can't take on clients and they can't make any money. Their clients are all calling them because they're panicking because their portfolios are dropped down. Us, on the other hand, we're doing the exact opposite. So we of course called our clients, just reassured them, but everyone was really chill. I think we had 2 clients call in asking questions.
Throughout that whole
the entire client bank, and we had our record month of new funds under management, so new money coming to the company, because all the people that haven't invested to date, prospects of mine that were considering investing or with other firms, their advisors were hiding their desk, not calling them because it's a difficult conversation to have. Your portfolio's gone down 15%, your portfolio's gone down 20%. But I'm the guy calling them saying, this is what we're doing about it. It's not a problem. This is what's happened throughout history. And they shifted all their money over to us. So we had a record month. It was a really good opportunity. We proved ourselves with our clients, and when the markets rose, the portfolios did amazing. So there was a really good end to the story after about a year or so, which is what I was telling them all at the time. This is going to benefit you all. The fact that the markets have dropped back, it just feels painful at the time from an emotional point of view, but pay no attention to it. Focus on your family, focus on your business or your career, and let me handle it for you.
I think that's testament to your mindset and staying headstrong, because a lot of advisors would see that as difficult conversations and pain, and they would potentially try and avoid conversations and put their head in the sand through a time where clients' monies are going down and down and down and down.
The problem, Josh, you've got to remember is most advisors, and again, I'll get shot saying this, most advisors...
You're going to get shot a few times with this podcast.
To scream this. Most advisors are relationship managers. They've done investment qualifications. Their technical ability is not, in my opinion, probably where I would want it if I was a client, and that's why most likely I look after more high net worth individuals. They've done some investment exams. Do they have a really good understanding how the funds portfolios work? Do they have really good market knowledge? There's very few advisors I've ever met who have had my background. They weren't a stockbroker previously. They didn't do a master's, and they didn't have a technical background, and I love that part of it. It's just if I did it every day, as an analyst, I think I'd feel a bit lonely, because it wouldn't be very client facing. So I think I've got the confidence to have the right sort of conversation with clients, and I know what I'm doing. I know what's going on behind the scenes. I understand the investment team. I understand the investment proposition. If you do not understand that, which some advisors definitely don't, they pick their portfolio in the middle, leave it to the investment team, rightfully or wrongfully, their job is client facing. So that's fine if some advisors want to operate like that. But the advisors that choose to do that will never have clients, or will rarely ever have a client who has 7 figures plus invested with them.
Yeah.
Because they tend to be more switched on investors.
And it's trust as well. If you don't have that relatability and that confidence in who you're dealing with, why are you going to hand over the keys to your fortunes and the results of all your hard work? You're not going to do it. A lot of client relation comes to trust.
Yeah.
You have to understand who you're speaking to, why they're going to help you, and why they're the best in the industry. And that can't be all speaking about financial markets and P&Ls and balance sheets. There's got to be some relatability there to yourselves as an individual, and a connection as well, which is coming back to what we said already, is why you've done so well for yourself, why you've got a great team, why you've got a great personal brand, because you've understood that there's more than just, here's the stock market, here's what we're going to invest into. There's the connection of who you're speaking to as well, which is huge. So talking like practical strategies then, if you're having a first meeting with a client, let's say me and you right now, when we're talking about my businesses, the funds that I'm potentially willing to invest.
Yeah.
What are you trying to lay out in terms of a strategy, and what's the actual process of going through that? Is it quick? Is it daunting? What's the process?
When I first meet someone who could potentially be a client, it can, funny enough, be a 5-minute conversation or an hour. And it really depends on the individual, how forthcoming they are with information. Sometimes, they can be a bit closed. Some people are really clear on what they want to do and they just pile out the information, and it's really efficient. So like if obviously me and you have had this conversation, it's easy for me to get information from you. You're really clear with your business goals, personal goals, where you are, your figures, how they expect you to do, doing what you do. And then it's really easy for me to get to the bottom of it and be like, right, we need to do X, Y, Z. And our initial conversation could be 5-10 minutes, because I would then save us time speaking for an hour, unless I was trying to develop the relationship, of course, but obviously we knew each other prior. And then I'd just move straight on to the next meeting where we'd do a full fact-finding exercise. We'd spend an hour or two getting to really understand your circumstances, goals, the bigger picture stuff, what you want to achieve over the next 5, 10, 15, 20 years. I've got to really understand you to advise properly in every respect, not just your finances. Sometimes when I have that initial conversation though, if people, depending on sort of character they are, I might need to spend the full hour, really get to know them and build rapport with them. And they might not be very good at conveying what they actually need or want. They might be a little bit unsure about what their actual life goals or financial goals are. They might have literally no clue. So I've got to try and help them establish that. And then when I've got enough information where I know I can help them personally, and actually add value, what I'll then do is I'll stop the meeting there, because I'll then take it to the kind of more detailed fact-finding meeting, because if not, I'm kind of duplicating and wasting their time. So it's almost like a mix between getting the right information, knowing I can help them, and qualifying them as well, are they actually suitable as a client.
Yeah, it's the same with us. Like you mentioned there, they don't actually potentially know what their goals are. And I feel like when you're making investment decisions, or you're doing tax planning, or you're looking at the next strategy for your business, you've got to understand what that long-term vision is, very crystal clear, because you then reverse engineer back from what you want. If you know what you want, then you're going to be able to reverse engineer the steps to actually get there. And if you want X amount of net worth or X amount invested, that should be a goal of yours, and that should be a progressive goal towards whatever that vision looks like. And that's when you then reverse engineer it and go, right, well, in order for me to have $1 million invested by the time I'm 35, I've got to do X amount. Dan, how would I do this? Where would I invest? What are the best options for me to get the best return on capital and get to this end vision as quick as I can? And I imagine that's the sort of conversations that you have.
And sometimes with some clients, you get there really quick. And obviously it's an ongoing process, right? Clients who've been with you 5-10 years, we've built their strategy, we're built on their circumstances, we've done loads of modelling, so you can add even more value as time goes on, and they get more value, monetary value, and in every sense. At the start though, some people are really hazy. You can ask them some very basic questions and they have no idea, because they've never thought about it before. If I ask them, and they can be really close to retirement, it could be someone in the UK who's 50, and I'm like, right, when do you think you're going to stop working, or when do you want? And they're like, I have no idea. I'm like, do you have any idea what you're going to need to live off? No, I have no idea. Well, like, what do you want to do in retirement? Don't know really. And then that conversation will take a long time. It can almost be a bit painful sometimes, because you've got to try and, it's a different element to the skill set you need as an advisor. And I'm sure, again, you've had very similar conversations. You've got to really try and understand them, and sometimes they give you surface level answers. So it's that kind of famous kind of line of questioning where it's like, but why?
Yes.
Or say something else and you're like, but why? And they're like, but because I want to spend time
Peel back the layers.
And they're like, right, okay, so it's all about spending time with grandchildren. That's why you want to retire early. But it takes a while to get down to kind of like the deeper emotional drivers on the decisions they make. And then it's easier for me to implement a financial plan, right? And say, right, we're going to do all this to get you there. But at the start, they sometimes just don't know why they're doing what they're doing, so to speak.
I mean, I think we've got some amazing gems so far about stock market, wealth management, investing. I do want to touch on self-development and actually your business specifically. But before we go into that, is there anything key you would say that we haven't discussed about investment strategies, wealth management for the entrepreneurs that are listening?
I think your questions have been amazing, John. So thank you. I think you've covered some really good points, especially ones that are actually practically useful for clients. I think the only other thing I would say, and this is really specific probably to the more the clients me and you come across in the UAE, is when someone has accumulated more wealth or become successful as a business owner, even if they are in early stages as a business owner specifically, you should have a good team around you. And this is something we've probably not really touched on. So this is where me and you obviously is our strong suit. So if I'm dealing with a client, I need to make sure they have a really good tax advisor accounting firm. I need to make sure they've got a really good legal firm to cover the corporate issues that pop up. I need to make sure they've got a good broker in place for, it could be insurance, mortgages, business broker if they're going to sell the business, a good estate planner because there's going to be inheritance tax issues specifically in the UK. So my job is to build a strong team of highly competent professionals around them, and that's something I think I've noticed here. You know, there's a mutual friend of ours who had this we had this conversation with recently, and I was like, you know, where you've got to in life already is phenomenal. You know what you've done with the business, but at the minute you've got 1 or 2 people in place, but you need a whole team, and you need them working together, talking, someone leading that, and making sure it's all pulled together because you don't have time. Because if not, you're going to have conflicting advice. The accountant will point to the estate planner will point to the corporate solicitor. So obviously it's been a blessing since me and you have started working together with obviously some of the high profile clients me and you both look after mutually, because between us we cover a lot of the bases, right? And then we just need to fill in the blanks with, say, corporate and some of the points.
Yeah. And I think just touching on that as well, it's important not just to have the best in each of the sectors you just mentioned, but it's important to have them communicating together. Because if not, the client who doesn't understand accountancy, finance and tax, or doesn't understand wealth management, or doesn't understand legal, becomes the messenger to speak to them different partners, but they can't be the messenger for something they don't really understand. So it gets translated in a way that may not give all of the detail that me or you need, which is why having a wealth manager and accountant that speak together about a client with a shared goal of getting them to X point, which is the vision we discussed that before, is really important. The same with legals, the same with inheritance, tax planning, whatever it is. Having a network around you of the best people, the best professionals, the best advisors, but also having them speak together is key.
Yeah, and that's what sets you apart, right? And why you've been so successful in your role, and obviously likewise at my end, because if you were brought into a room with one of your business owner clients, right, and they had an existing advisor who wasn't me, you know, and with the knowledge you've built up on wealth management specifically, you know, you're about to look after your client's best interests. And I mean this in the politest sense, cool bullshit if something isn't right. You know, if they're paying too higher fees, if the way they're structuring the portfolio doesn't look quite right, and, you know, and you'd probably consult with someone else or me and say, look, like, does this look right? And the same, you know, I have to take that responsibility. I've chosen to take that responsibility with clients and to be not just their wealth manager, you know, look after stuff across the board and bring everyone in a room, coordinate it, and make sure people are doing their job properly. And it takes a bit of time, you know. We've had to build knowledge up. We go on to obviously self-development, but build a little bit of knowledge in some of the fields. And I know that can be dangerous sometimes, but I mean, you don't start, I would certainly start advising on tax. I'm sure you would do the same with wealth management, but having a base level of knowledge where you can spot stuff and say, right, you know, this business sale's coming up in a few years. I know bare minimum 2 years out, you should be doing due diligence with a good corporate solicitor. You'll actually save money. But a client will be scared to engage in a solicitor early because they're going to be thinking about costs. And I'll give them real life examples of how it's played out with my clients, you know, and your average wealth manager, tax advisor, accountant, whatever, would never typically do that. And that's what sets us apart, right?
Yeah.
Bringing it all together.
So we're entrepreneurs with businesses as well. So we also understand that we've had to deal with these issues ourselves. So we can translate it to the business owner then and spot opportunities, which is key. So we talked about self-development. You've obviously developed very quickly. I'm sure you've read books. I'm sure you've done podcasts. I'm sure you've done events.
Yeah.
What would be your one golden nugget for everyone in the audience for self-development?
Me and you.
Too kind.
No, but I think the biggest thing, right, is reading. It sounds so boring, but if you look across some of the most highly successful people I know, they take the time to read almost daily and probably get through a decent amount of books a year, and it'll be a wide range of topics. It might have everything from psychology to business books to a bit of history to marketing. The way I look at it is whatever your role is. So for me in wealth management, there's so many different skills you really want to develop. You know, you want about to market. There's a sales element to the job, I suppose. There's a psychological element. There's a communication element. You know, what you need to be able to communicate effectively. You need to have good emotional intelligence. There's leadership skills. So we're talking about kind of like some general, I suppose, skills or traits that would make a good advisor. But then there's more practical stuff. So you want to have a bit of legal knowledge. You want to have a bit of tax knowledge, for example. You want to understand how corporate structures work, businesses sell. So taking the time, I mean, at the minute I'm doing some work in private equity. I'm doing a private equity course. You know, it's hard when you're in the position me and you are, where you're running around, you've got no time to then think, right, I'm going to go on a 3-month course and do 10, 20 hours a week studying private equity.
That's what sets you apart, though. That's what sets you apart.
Exactly, but it pays dividends because you will never, I mean, I can't think of one wealth manager I know who will have the knowledge I have on private equity. And I did a venture capital course literally the year before. And that has led to me working more in that space and doing more unique opportunities with clients as a result of it, because I don't want to know at the surface level, you know, I need to get that a bit further.
Yeah.
So reading, I think, is a game changer. Sadly, I didn't start as early as you, Josh. I started when I was 30 and I was terrible at reading, and it took me like 20 minutes to read 10 pages, you know, read the line twice.
I think I started in the womb, to be honest. So I think the big
You're a very special person.
My answer is very similar to yours, though, and it's looking at that vision that we discussed. What are the skills that the future version of you, in order to reach that vision, is going to need?
Yeah.
It's breaking that down into all your different sections: sales, marketing, communication, and then finding the best books in all of them spaces. And then just accumulate as much knowledge as you can. And also finding people that have expertise, that have already done a 10, 15-year journey to acquire skills, and then pay for mentorship, pay for shortcuts, because the more shortcuts you pay for, the faster you get to that vision.
Absolutely.
And as we know, entrepreneurship, there's a great return. If you can acquire the right skills and deploy them in the right places, you get a great return. So pay for shortcuts.
Look, we met at a mastermind event, right? Case
Of
in
course.
point.
Yeah, case in point, for sure. So I genuinely think that they've got some real gems there on wealth management, self-development. We've covered a lot. I always like to try and end the podcast by having one really clear, actionable takeaway that they can get alongside the 20 ones that they've already probably got. But is there anything that you can condense that you would just say, here's the clear, actionable insight of what you need to do, wealth management, investments, etc.?
Right. I think probably the clearest one, and it summarises one of the points we spoke about earlier, is people think financial advice, wealth management is for the wealthy, and it's not. It just gets more complex for wealthier people, and you need a different type of service. So I think taking advice, even if it's kind of from a local advisor, a lot of them would see you for free, you know, just have an initial consultation. You can assess whether they're going to add value for you. I think just seeking advice is probably the biggest takeaway, where people don't. I have no idea why people don't. I think they're worried maybe about cost, when it wouldn't be a cost just to go and see someone. And alongside that, financial literacy, just spend a bit of time building up your knowledge, because money isn't taught in schools. Most people's general knowledge on money is shocking. And if they just spent a bit of time building their financial literacy, kind of learning a bit more, even before going to an advisor, they would be in the top kind of 5-10% in terms of like the sort of difference they're going to be able to make to their lives. So that's probably the biggest actions they could take.
Similar to business, right? Just start.
Yeah.
Just start, and that first starting block is
a couple of
get
books.
advice. Yeah.
You know,
For sure.
speak to someone who works in the industry and ask them, you know.
Thank you very much for your time.
No,
I feel that has been very valuable. So I appreciate your time, and I'm sure we'll see you on the pod again.
Yeah, some amazing questions.
Thank you very much.
Thanks for having me.